Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Michael Rosen, Chief Investment Officer at Angelus Wealth Management, to discuss taking profits and investor behavior. Michael, it's great to meet with you. Welcome to Trade Talks.
Nice to be with you, Jill.
And I guess the key question is, when should investors take profits when markets continue to trade near all-time highs?
Well, never is probably the short answer. Market highs are more likely to be followed by another market high than it is to be followed by a sustained drop. By that logic, investors would never be invested in a bull market because a bull market, by definition, is continually making new highs. So, if anything, a market high to me is a more bullish signal than it is a bearish signal, but probably has very little signaling effect really for most investors.
But what about the current state of the economy? Why should investors be investing in stocks in this market? I mean, as you're well aware of, it's very K-shaped. I know it's an overused term, but as well as things might be doing within the financial markets and technology space as examples, not everything in the economy is firing on all cylinders.
Yeah, that's always true, though. There's always reasons to be bearish and always reasons for worry and concern and valid reasons indeed. But one of the characteristics of bull markets actually is investor skepticism, investor caution. Now we're currently seeing a bit of enthusiasm among investors, and that is a cautionary sign, but there's still an awful lot of cash sitting in banks and brokerage houses, and certainly on corporate balance sheets, record amounts of cash. So there's definitely cash to be invested, but these are really very, very short-term concerns and issues. I think it's key for investors to consider really all aspects of the data in trying to assess what's going to happen with markets, which financial assets will be favored and which will be out of favor. And there's always more than one side and maybe more than two sides to every argument. So I get the fact that there are 10 million fewer Americans working today than there were a year ago, that many Americans, millions, are still dependent on government subsidies and loans and unemployment insurance, for example. We've just come through a year just truly extraordinary, a global pandemic that none of us have ever experienced, where the global economy was effectively shut down, civil unrest that we've seen in the streets over last summer, and then of course more recently at the Capitol, all sorts of reasons to be concerned. On the other hand, profits are at record highs. And we have a global economy that will be growing at the fastest pace this year than we've seen in 30 or 40 or maybe even 50 years. So we also have a fiscal policy that is highly supportive of economic growth, and a monetary policy that's also very accommodative. The Fed has indicated it's simply not going to tighten policy for probably a few years at least. So there's more than one side to the equation of how to assess what's happening in the economy. The fact is that over time, and this is, I think, maybe the key to investing in the stock market, that we've heard before, the stock market is not the economy, and that's clearly true. But what the stock market is reflecting, I think, is the extraordinary magic of capitalism. That is the ability and necessity for companies to adapt and to innovate. And that is what gets reflected in the stock market, regardless of whether tax rates go up or down, whether inflation is rising or falling, when growth is slowing or increasing. Companies have the ability to adapt and to innovate. And those that don't go away, they get bought, they go bankrupt, and what's left is a stronger market where stronger companies lead the way. And that's, I think, what the stock market is reflecting. So yes, there's a lot to be concerned about and worried about in the economy, in the country, in our society, in the world, climate change, global pandemics, but there's also a lot of positive news as well, and the market, I think, reflects a lot of that.
So Michael, with the last minute here, what's the real question that investors should be asking themselves?
Right. So, part of this is sort of who you are. If you're a 25-year-old just starting a 401k, the best advice I have is to put as much money into equities in each paycheck as you can, and don't even think about it for 30 or 40 years. Regardless whether markets go up or down, it really makes no sense other than to just stay continually invested. But I think for investors, I think I would just remind people that we have been through very difficult times in the past. And in fact, I did a webinar a year ago or so that looked at major events, important events over the last 80 years or so, and the effect it had in the stock market, starting with the attack on Pearl Harbor and running through the Kennedy assassination and 9/11 and Watergate and every single case of these, after these very important events, markets recovered within months and at most over a year. And so it's important to sort of keep in mind and keep the perspective that the stock market, again, reflects the ability of companies to adapt and to innovate, as opposed to what's happening in the very near term in the economy. One other example I noted in that webinar is 1968, a year that was probably the most chaotic and violent the world has seen in a very, very long time, with multiple assassinations, terrorist attacks, riots in the streets all around the world. The market was up in 1968. Again, it's what's happening in the economy today is not what the market cares about. It's the market is looking to the future, to what's expected to be better times than where we are today.
All right, Michael, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.